Hello and very warm welcome to the platform of Victory IAS. As you are aware that we are discussing 2 years current affair rapid revision series. So let's discuss current affairs updates related to economy subject. Unpublished price sensitive information. It is related to stock market and securities exchange market. So it is under SEBI, as we have already discussed. This capital market and entire stock market is under Securities and Exchange Board of India. So it is under SEBI. And what do we mean by price sensitive information? There are certain information which is not available in public domain generally it is not available in public domain, but since if you are a part of that particular organization, or maybe through any means you get access to those information which are not available in public domain, but if you have access to those information, then you may have advantage or edge over this trading of securities, etc. So those are known as sensitive, unpublished price sensitive information. The SEBI recently proposed significant changes to the definition of unpublished sensitive information, that is UPSI, to ensure regulatory certainty and uniform compliance among listed companies. So whatsoever and whosoever is listed under under stock exchange, now those companies should be having should have to follow these norms, right? The proposal aims to enhance transparency and timely disclosure of material events or information. Now it is related to this. When we talk about definition of UPSI, etc., consultation paper, the SEBI consultation paper suggests that amending current definition of UPSI and bringing the disclosure required under regulation 30 of LODR. What is LODR? Listing obligation and disclosure requirements under its purview. The objective is to provide clarity and consistency identifying specific events as UPSI. Now you have to remember only what is UPSI and what kind of what kind of impact it may create, right? Listed entities have obliged under regulation 30 to disclose material events or information promptly within 24 hours of their occurrence. So any event that may impact the share prices, etc., the disclosure is mandatory under within 24 hours with the events. These events encompasses wide range of factors such as acquisition, agreements, fraud or default by promoters, alteration in securities, rating revision, forensic auditing initiation, and changes in directors and key managerial personnel. Now these kind of decisions or these kind of events may impact share prices as well. Board meeting outcomes also. So additionally, listed entities must disclose the outcomes of board meetings pertaining to dividends, right? Not everything, but if it is related to dividends, that is profit sharing, financial results, voluntary delisting, and more within just 30 minutes of meetings closure as per the rules, right? This has been mandated. And this public comments and analysis in study conducted by SEBI and stock exchange in 1099 press releases from the top 100 listed companies between January 21 and September 22 were analyzed, and surprisingly 1.64% of these press releases were categorized as UPSI by the listed companies, right? So that kind of information is also sometimes available. Now insider trading is a big concern with respect to this. Now it is directly connected to insider trading. What is insider trading? As we have already discussed in previous data, that insider trading is about access to those sensitive information which may impact the share prices, but it is not available in public domain. Since you are part of that particular organization, then you are having access to those information. So insider trading concerns are also there. The case of alleged insider trading raised concerns over the inadequate categorization of information as UPSI by companies, right? So this is related to this. Now the changes has been approved by SEBI during its board meeting in March. SEBI approved several changes to enhance the disclosure, etc. So this is related to this. Now one more topic related to all-in-one insurance policy plan. Now since one concern related to insurance is insurance penetration. What do we mean by insurance penetration? How much population is taking insurance and they are part of this insurance business, means they are paying premiums, they have taken some kind of policies. That is known as the insurance penetration. What do you mean by penetration? Means how much penetration is there of insurance sector in entire population, right? So it has to be enhanced, it has to be increased. That is the overall objective here. So when we say that it has to be increased, we need to understand that what kind of policies we can make so that insurance become more inclusive in nature, right? So it is one of such policies that is all in one. We will be the entire promoters of insurance, etc. These people will be promoting bundle of this insurances, right? For example, life insurance is different, health insurance is different. So combining all together in a bundle and then presenting it to the customers, right? The Insurance Regulatory and Development Authority, IRDA, we have already seen that it is the nodal authority with respect to insurance, right? In India is working on an all-in-one policy plan to address the low insurance penetration in India. What is the aim of such policy? That to offer an affordable bundled insurance product that covers health, life, property and accident risk, to expedite claim settlements by linking death registry onto a common platform. So there will be a common platform on which the death registration will be done, and insurance firms will have access to that particular platform and they will be able to get the data, right? So there is entire procedural work is there. For example, post-mortem reports, accidental death report by the police, etc. So those documents are mandated there. But if we are having one common platform and insurance firms can access that particular platform, it will make the work seamless, right? To create UPI like moment in insurance, similar to unified payment interface in the banking sector, like we have seen the kind of overhaul or the kind of reform or the revolution kind of moment we have seen in UPI with the help of UPI in banking sector. Like it has the financial inclusion also, it has played a very important role in financial inclusion. So that kind of thing we want to witness in insurance sector also. Planned by IRDA, Bima Trinity of the policy. So if we talk about this portal, Bima Sugam portal, the portal will integrate insurers and distributors, providing customers with one-stop shop for purchasing insurance policies and managing service requests and claim settlements. It will also be integrated with digitized birth and death registries. Bima Vistar, another portal, will be bundled risk cover. It will be bundled risk cover products which offer defined benefits for each risk and aims to provide faster claim payout without need of surveyors, right? So access from a common platform will be there. Bima Vahakas, the third component of the plan, involves deploying a women-centric workforce called Bima Vahakas, that is carriers, in each Gram Sabha, that is village council, to promote the benefit of insurance products. Now, other plans, if we talk about state level insurance committees, right? State level insurance committee to achieve the goal of providing insurance coverage for all citizens by 2047. IRDA plans to establish a state level insurance committee and involve state governments in formulating district level insurance plans. Amendment to insurance laws, if we talk about this, Insurance Act 1938 allow differentiated capital requirement for niche insurers. Niche insurance means with respect to different sectors, specific sectors, attract more investment and enable the addition of value added services to insurance policies, right? These are few plans for making insurance more accessible. It will provide citizens with affordable single policy that covers health, life, property and accident. Now, settling claims within a short time frame, potentially within 6 to 8 hours of a maximum of 1 day. Now, it also plays a very important role when we talk about settling the claims. Sometimes people face a lot of difficulties deliberately. Certain loopholes are there, and those loopholes are certain times these insurance companies take advantage of those loopholes, and they defer claims sometimes and they don't disburse amount, etc. Then litigation also takes place many a time. So settling claims within a short time frame, that is 6 to 8 hours or within 1 day, is a very important step. Will allow policy holders. Now this is the challenge, these are the challenges why insurance businesses are not popular among people, and why people are not attracted toward these things, because sometimes claims are not being disbursed properly. Easy access to their policies and submit death certificates, enabling quick processing and transfer of funds. Issue with the current insurance law. What are the issues? The current insurance laws do not allow the inclusion of value added services along with insurance policies, right? So for instance, insurance companies are restricted from offering additional benefits like annual yoga membership or nursing services. So these things attract people to take insurance policies like this, right? So these are the things. The Insurance Regulators and Development Authority of India, that is IRDI, having headquarters in Hyderabad, is a statutory body under this particular act and under the jurisdiction of Ministry of Finance, is tasked with regulating and licensing insurance and reinsurance industries in India, right? Now, special rights for unit holders. It is unit holders and REITs and InvITs. It is related to real estate investment trust, and InvITs is related to infrastructure, right? It is related to infrastructure investment trust, right? So infrastructure and real estate. Special rights for unit holders. The Securities Exchange Board of India, that is SEBI, has put forth a proposal aimed at granting special rights to unit holders for real estate, that is real estate investment trust, that is REITs, and infrastructure investment funds, that is InvITs, thereby expanding their participation in the decision making process. Now, if we talk about empowering these unit holders who have these invested in these trusts, under the proposal, SEBI suggests providing unit holders with the right to nominate a representative in the board of REITs and InvITs. This move aimed to empower unit holders. So unit holders will be having their own representatives, monitor their investment and more effectively by assisting in crucial decision making process. Now, introduction of self-sponsored REITs and InvITs. In addition to the special rights of unit holders, SEBI has also proposed the concept of self-sponsored REITs and InvITs. What are self-sponsored? This new framework would create opportunities for mature and independent professional managers to emerge and provide an additional exit option for sponsors. Applying steward code. What do we mean by steward code? That's SEBI have also proposed that applying principles of the stewardship code to the members nominated by unit holders on the board of directors of investment managers of REITs and InvITs. This application aims to ensure responsible and diligent management of investments, right? Now, when we talk about the significance of REITs and InvITs, since these things we already study in this static part of the syllabus, the introduction of REITs and InvITs in India has opened avenues for investors to gain exposure to real estate and infrastructure projects while mitigating the risk through pooling arrangements, right? People are gathering themselves and they are putting their money, pooling, right? That is pool of resources. REITs primarily invest in completed and rent generating real estate assets, while InvITs have flexibility to invest under construction assets also, as well as completed and revenue generated. Now, when we talk about participation in decision making process, this unit holders, to ensure the participation of unit holders, they constitute distinct unit holders council, right? This is few things you can remember from this entire discussion. You will not be able to remember in exam, but the idea here is to discuss, at least to have some idea of that particular topic, so that when you encounter question in the examination, you will be able to answer question, right? That is the idea here. Now, when we talk about qualified institutional buyers, when we say these institutional buyers are the people who are investing, right? Who are purchasing those shares or those debts, etc., debt instruments, etc., right? So they are known as qualified institutional buyers. SEBI is taking steps to broaden the scope of qualified institutional buyers so that the investment can also increase, aiming to enhance the investor base of the insurers to issuers of debt securities. SEBI aim to expanding the definition of qualified institutional buyers is to diversify the investor base, enabling wider pool of potential investors for issue of debt securities. So people, when they are issuing debt securities, why they are issuing debt securities? To raise fund from the market. Now, suppose people are not aware and people are not willing to purchase those things, those debt instruments, then the firm will not be able to generate fund. So when firm wants to generate fund, that means someone should be there to purchase their debt securities, and that is qualified institutional buyers, including various entities in the expanding definition. So what you can see here, under the proposed expansion, SEBI plans to include several type of entities as qualified institutional buyers. These institutions include multi-state cooperatives with net worth exceeding 500 crore rupees. We have already seen in the last class what is multi-state cooperatives and what kind of new this supervisory mechanism has been introduced with respect to multi-state cooperatives. Non-banking financial financial companies. NBFCs, we have already seen, it is a kind of heterogeneous group, very heterogeneous. We're having capital base from 5 lakh to 500 lakh crores, etc., 5 lakh crores, etc. So those big non-banking financial companies are also there. Some NBFCs which are having very high capital base like 5 lakh crores, they are also allowed to accept deposits. Those things we have already seen. Housing finance companies, pension funds, including overseas pension funds, NPS trust, national payment system, and employee provident fund organization, that is EPFO. Refinancing agencies like Mudra, reinsurance companies, and some and small finance bank, that is SFBs, as we have already seen, like AU banks or something like that. Additionally, other SEBI regulated entities with a net worth of more than 500 crores will also be incorporated. So they are broadening the definition of qualified institutional buyers so that these debt instruments can be purchased, right? Significance of qualified institutional buyers in debt securities: they play very crucial role in funding issuers seeking capital through private placement of listed debt securities. As per available data, QIBs have subscribed to approximately 94% of total funds raised through corporate bond issues. So I hope you can understand what kind of role they play in purchasing those debt securities in corporate bond market via private placement. This underscores the importance of QIBs as a significant funding source for issuers, right? Now, when we talk about boosting debt securities market, debt securities means you are raising fund from the market on the basis of debt. That means you have to pay back, right? Shares are equity, right? That is, you are having some ownership rights and you will be paid dividend or profit. SEBI's proposal aligns with its objective of creating thriving debt securities market in India. By expanding the definition of QIBs, SEBI aim to encourage greater participation from different entities, ultimately facilitating increase in investment activities in liquidity in the debt market, right? So that when they will raise these securities, they will issue these securities, someone will be there to purchase, right? The role of QIBs in private placement. Private placements means they are purchasing it privately, right? QIBs hold significant position in the private placement of listed debt securities. Their active participation through subscription to corporate bonds issued via private placement channels has been instrumental in facilitating smooth flow, right? These things. Now, IRDAI relaxes norms for surety bonds. We have already seen surety bonds for infrastructure projects and all, where if someone is some contractor have left project in between, then from this surety bonds, they will be next contractors will be given fund, right? That is surety bond. Insurance Regulatory and Development Authority of India has recently made significant changes in the norms governing surety bonds, a type of insurance policy that protects parties involved in transaction of or contract from potential financial losses. The objective of the amendment is to promote the growth of the surety insurance market and enhancement accessibility of these products. We have already seen that this is related to government contracts mainly, right? Surety bond related to government contracts. So relax solvency requirements and exposure limits. So this is we have already seen, so I will not go into the details again. Impact of the on the infrastructure sector, it is there to have some kind of surety that the project will not stop or will not halt. Risk mitigation, contractual terms, expanding opportunities across various sectors, we have already seen. Now, new topic is prohibition of differential rights to alternative investment fund investors. So when we talk about alternate investment fund, there should not be any bias, right? When this alternate investment fund is there to subscribe shares, etc. So when it is there, it should not be biased. That is why prohibition of differential rights. Differential, that means you have to treat everyone as equal in the market. The SEBI, the regulatory body overseeing the India's financial market, has put forth recommendation to ensure fair treatment and proportional rights of alternative investment fund. These proposals aim to safeguard the economic interest of all investors while maintaining transparency with AIF scheme. Understanding AIF and SEBI's objective: alternative investment fund are privately pooled investment vehicles that collect fund from investors for the purpose of investing according to defined policy benefiting participants, right? SEBI's primary objective is to establish guidelines that prevent any differential treatment, so that everyone should be treated equal, that is equal treatment of AIF investors. Has recommended that AIF investors, SEBI has recommended that AIF investors should not be subject to differential treatment that could impact the economic rights of other investors. It aimed to create a level playing field, ensuring that no investor receives preferential treatment that might disadvantage others. This measure promotes fairness and equity among AIF participants. Now, when we talk about preservation of pro rata rights, etc., this SEBI has emphasized on maintenance of pro rata rights of investors within AIF schemes. This implies that each investor's right should be proportional to their commitment and investment in each investee companies. Now, when we talk about conditions for differential rights, SEBI has discouraged differential treatment, but it allows specific differential rights regarding the hurdle rate or return performance link fee and management fee, etc. These terms enable flexibility in providing incentives and rewards to investors based on the performance of the AIF, that is Alternative Investment Fund. Now, these are related to this. Now, surety bonds, we have already discussed. Some changes are there, that is the solvency requirement for surety bond has been reduced to 1.5 times from the previous 1.875 times, and exposed limits for 30% applicable to each contract underwritten by insurer has been removed, right? Otherwise, we have already discussed this. About ILDI, we have already discussed. The headquarters is in Hyderabad. It is a statutory body under the jurisdiction of Ministry of Finance. We have already seen it. It is tasked with regulating and licensing the insurance and reinsurance industries in India. ILDA to tighten rules on insurance advertisements, right? So sometimes misleading advertisements, etc., are there. To curb on those kind of practices. The Insurance Regulatory Authority of India, IRDI, is to statutory body responsible for regulating and developing the insurance industry. Recently, Regulatory Authority proposed tightened norms for insurance advertisement by assigning higher responsibility to the senior management of insurers in designing the approving media campaigns for product promotion. Now, what are the proposed amendments to directives on insurance advertisement that we have to see? So IRDAI has suggested making changes to the guidelines for insurance advertisements and disclosure that were introduced in 2021. Under the proposed amendment, now each insurance will be required to constitute an advertisement committee comprising of at least 3 members to undertake marketing, that is actuarial and compliance functions of the insurer. The objective of the amendment is to assign higher responsibility to the senior management. Now, responsibilities for advertisement and product management committees, when this committee will be formed, which is of not less than 3 members, the panel will be required to report to the product management committee, which will be the final authority to approve or reject the advertisements after examining the recommendation of the advertisement committee, right? The product management committee and advertisement committee shall be accountable and fully responsible for the releasing the approved advertisements. The insurer's product management committee needs to adhere to the record retention policy of the insurer and maintain data on all advertisements or for a minimum of 3 years after the advertisement withdrawal date, right? Now, importance of advertisements in the insurance industry is these are considered as an integral part of the product filing procedure. Currently, the acceptance of advertisement is based on the approved application of file and use and adherence to IRDAI regulation and circulation on advertisements, right? So this is about. Now, London interbank this offered rate. This has been a benchmark since a very long period of time, right? LIBOR, as we call it. The Reserve Bank of India has issued advisory to banks and other regulated RBI regulated entities, asking them to take steps to ensure a complete transition away from LIBOR, that is interbank offered rate from July 1, right? London interbank offered rate LIBOR from July 1. Now, certain things related to it. What is LIBOR? So it is a benchmark interest rate at which major global banks lend to one another in the international interbank market for short-term loans. For example, bank is facing certain shortage with respect to funds, and they have to give, for example, depositors are demanding their money, maybe time deposits or the kind of And one we have seen time deposit which gets matured after a certain time, like fixed deposit, and one we have seen demand deposit. For example, you have put your money in your saving account, so whenever you want you can demand that money, right? So demanding that particular money, that is demand deposit and time deposit. When we talk about this demand deposit and time deposit, demand deposit especially, people can demand at any point of time. Suppose if bank is not having that much fund available, so what banks will be doing, what banks will be doing, so banks may borrow from another bank, and when it is happening at international platform, then it is known as the rate will be LIBOR. It serves as short term loans with maturities from overnight to 1 year, so less than 1 year, that is why short term. It also acts as a basis for corporate and government bonds, mortgage, student loans, credit cards, derivatives, and other financial products. How does LIBOR work? So administered by ICE, benchmark administered administration, that is IBA, regulated by the UK's Financial Conduct Authority. It is based on why LIBOR being brought to an end. Now, why RBI has said that we should go away from LIBOR, why it has come to end? Because it is based on 5 currencies including US dollar, euro, British pound, the Japanese yen, and the Swiss franc, right? And serves 7 different maturity period. LIBOR's credibility was damaged by rate fixing scandals in 2012. The panel banks submission were alleged to be inaccurate or manipulated to project market strength. After the 2012 Wheatley review, a number of reforms were introduced to reduce subjective input and make LIBOR a transaction based benchmark. But however, what are the alternative references rates we are having? So however, despite reforms introduced, the number of transactions in the short term wholesale funding market reduced over time. Thus, LIBOR became more vulnerable to short term market liquidity and amplification of price moves that could cause systematic risk. Now, secured overnight financing rate SOFR being widely used as substitute of LIBOR across the world, right? Other benchmark rates are CHF, Saron, EUR, that is Easter, GBP, Sonia, already in use since March 31, 2012. JPY, Tona also. What are the limitations of this SOFR? Based upon the repurchase repo market, is it is at the repo market's mercy. So it is mainly linked with the repo market, that the RBI repurchase obligation we have already seen. There could be a lot of volatility in the financial market as the deadline arrives. The RBI has issued 2 circulars giving roadmap to the transition and arrangements to be made for the same. So now LIBOR is not has come to an end. Now LIBOR is not being used in interbank transactions, right? Now, front running, it is related to again sensitive informations that the people are having, which may influence the share market or trading of securities. So the SEBI has banned 5 entities including an employee of Life Insurance Corporation of India, that is LIC. It is a PSU, public sector undertaking, established through an act of the parliament, from the security market for front running. So what is front running? It is illegal practice in the stock market where individual or entity trades based on advanced information obtained from a broker or analyst before it is made available to their clients. So clients are not having those information with them. For example, suppose a broker receives a large order to buy share of company X from a client. Before placing the order on behalf of the client, the broker may purchase shares of the company X for their personal account also, right? Knowing that the client's order will drive up the price of the share. Once the price of the share rises, the broker can sell and can make profit. So it is not not good practice. So that is why, to prevent these kind of fraudulent activities. Dabba trading, which is not this trading is not happening through the proper channel. So National Stock Exchange has issued several notices in the past week warning retail investors not to subscribe to invest in dabba trading. So it is happening outside the official setup. So what is dabba trading? Informal trading outside the purview of stock exchange, centered around stock price movements. However, trading is done without actually buying or selling the stock on a formal stock exchange. So it is not happening on formal. For example, if an investor place a bet on particular stock at a price point rupees 1000 and the stock price later rises to 1500, the investor would make a profit of rupees 500. However, if the stock price fall to 900, the investor will have to pay the difference through the dabba broker, right? So the risk involved, that is lack of investor protection, dispute resolution mechanism and grievance redressal mechanism is not available, right? Wherever or for that matter, if you are going through official channel, you have these things available, right? The possibility of broker defaulting in paying the investor or entity becoming insolvent or bankrupt. This is the challenge here. How it is facilitated? Transactions are facilitated using cash and operated using unrecognized software terminals. Why it is problematic? Because helps dabba traders escape taxation and remain outside the purview of the formal banking system, because cash and cash etc. and unrecognized softwares are being used. Legal implication is it is recognized as an offense under this section 23 clause 1 of Securities Contract Regulation Act SCRA 1956, and upon conviction can invite imprisonment for a term extending up to 10 years of a fine, or a fine up to 25 crores or both, right? Now when we talk about National Stock Exchange of India Limited, headquarters is in Mumbai, is one of the leading stock exchange in India. NSE is under the ownership of various financial institutions such as banks and insurance companies. How is the stock market regulated in India? We have already seen SEBI is having this statutory powers, right? Background is this is followed by Hindenburg research report. I hope you can recall, it was much in news, right? Hindenburg from US, they also alleged with respect to Adani etc. for short selling, right? So and it is short selling firm. So this followed by the Hindenburg. For example, the Supreme Court recently asked the SEBI and the government to produce the existing regulatory framework in place to protect investor from share market volatility, right? It is highly volatile. Retail investors had made losses in crores, in thousands of crores, lakhs of crores when we talk about retail investors. Background is after Hindenburg research report, which accused the Adani Group of stock market for the manipulation and accounting fraud. Share or a stock market is a component of free market economy where various kinds of stock, shares, bonds, securities are traded, that we have already understood. It allows companies to raise money and investors to participate in the financial achievements of the companies, make profits through capital gain and earn income through dividends. That is the kind of profit that the firm is making. Now when we talk about this securities market in India, regulated by 4 key laws. The Companies Act 2013, through which the company will get registered, right? So regulates the incorporation of a company, responsibilities of a company, directors and dissolution of a company. Then the SEBI Act of 1992, it empowers SEBI to register intermediaries like stockbrokers, merchant bankers etc. and portfolio managers, regulate their functions, improve penalties including suspending or cancelling the registration. So SEBI becomes what? A regulator, right? Securities Contract Regulation Act 1956 SCRA empowers SEBI to recognize and de-recognize also stock exchange prescribed rules and bylaws for their functioning. When we say bylaws, it is the kind of law is making law is the authority of legislature, maybe state legislature or union legislature, that is parliament. But when these bodies, these statutory bodies etc. given rights to make laws, they are known as bylaws. And regulate trading, clearing and settlement in stock exchange, right? The Depositors Act 1996 introduced and legitimized the concept of dematerialized securities being held in electronic form, as earlier we used to have shares in physical form. SEBI set up the infrastructure for doing this, registering depositors and depository participation. Can SEBI step in to curb the market volatility? While SEBI does not interfere to prevent market volatility, exchange have circuit filters, upper and lower circuits are there. Sometimes when it is becoming volatile, circuit breakers are also being used to prevent excessive volatility. But SEBI can issue directions to stock exchange to stop trading totally or selectively. It can also prohibit entities or persons from buying, selling. That is the power that the SEBI is already having. We have already discussed this. What are the guidelines for fundraising? So the Companies Act has delegated the authority to enforce some of its provision to SEBI, including their regulation of raising capital, corporate governance, resolution of investor grievances, etc. As a result, SEBI issued guidelines such as issue of capital or disclosure requirement regulation, listing obligation and disclosure requirement regulation 2015, seen, etc. What are the safeguards against fraud? Circuit breakers, we have already seen one. Fraud undermine regulation and prevention, prevents a market of being fair and transparent. SEBI notified prohibition of fraudulent and unfair trade practices, regulation 1955, and prohibition of insider trading, regulation 1992. These regulations have defined different types of fraud and provide penalties, and violation of these regulations is presumed violation of Prevention of Money Laundering Act, PMLA, right? SEBI has been given the powers of a civil court and used this power. SEBI has acted against Satyam, Sahara India, Ketan Parikh and Vijay Mallya, etc. These frauds, I hope you must have heard about it. Now, how these appeals are made? So, SEBI order goes to this Securities Appellate Tribunal, and then Supreme Court related, then it goes to Supreme Court. Now, if we talk about related news with respect to SEBI here, so SEBI has mandated stockbrokers and depositors, participants to maintain a website to help investor. The capital market regulator SEBI has recently asked stockbrokers and depository participants to maintain a website, right? A stockbroker that is registered with SEBI is a member of recognized stock exchange who is permitted to do trades on the screen based trading system on different stock exchanges. A depository is an organization which holds securities like shares, debentures, bonds, etc. of investors in electronic form at the request of the investor through a registered depository participant. A depository participant is also an agent of the depository because they hold, right? So, depository, for example, National Securities Depository Limited (NSDL) and Central Depository Services India Limited (CDSL), through which it interfaces with the investor and provides depository services, right? The rationale behind the website: it will contain basic details such as their registered address, registration number, give customer relevant information right from the process of opening an account to filing a complaint. All these informations will be available to the user. So basically it is to protect the interest of the investor, right? So that they should not fall in any kind of trap. Social stock exchange, we have already seen. National Stock Exchange of India has received final approval from SEBI to launch a social stock exchange as a separate segment of NSB. You have to remember that social stock exchange is for both for-profit as well as not-for-profit organization, right? To provide new avenues of social enterprise, we have already seen. So this information we have already seen. The minimum size is 1 crore. That is also we have seen. Zero coupon, zero principal, I have already explained you in previous videos, so that is fine. We have already seen. Now, India's first municipal bond index. We have already seen this third tier of the government, also known as urban local bodies. They are having municipalities and panchayat. So municipalities, for their expenditure and all, they can issue bonds. So National Stock Exchange launched India's first municipal bond index, IBMX, right? IBMX Municipal Bond Index. It will track the performance of bonds issued by municipal corporations, investment grade credit rating, that is AA category. The index includes municipal bonds issued as per the Securities Exchange Board of India issued and listing of Municipality Debt Securities Regulation 2015. A municipal bond is a type of bond issued by a legal government or municipality such as city, country or state. You know municipalities from your polity information. When these entities need to raise money, fund projects like building schools, road or other public infrastructure, they can issue bond as a way to borrow money from the investors. The municipal bond market has seen a threefold rise in fundraising since 2017 to about 6,000 crore in 2022. The first municipal bond in India was issued by the Ahmedabad Municipal Corporation in 1998. Indore issued India's first ever municipal green bond. Green bond to invest in climate resilient structures and all, that is green bond. India's first ever REITs and InvITs index. So REITs and InvITs, just now we have seen, it is related to real estate and infrastructure trust investment, infrastructure related trust, right? So infrastructure investment trust and real estate investment trust. So a kind of index will be made, right, to track the performance of REITs and InvITs are publicly listed and traded on NSE. Now we have already seen what are NSE indices. So NSE is having headquarters in Mumbai, subsidiary of National Stock Exchange of India. NSE indices provide a variety of indices of an index related to products and services of Indian capital market. Now when we talk about mutual fund trustee, mutual fund, we have already understood that it is a pool of shares. So share from different sectors, different industry can be there, and it will be sold as one unit. It will be sold as one unit. So one unit is being prepared from different shares, etc. Mutual fund trustee, SEBI has proposed to review the role and accountability of trustees of mutual funds, as well as put in recommendation. Because one thing you have to understand, who is managing this, who is taking different shares. For example, pharmaceuticals, infrastructure, education, medicines, other different industries, cement industry, steel industry. So their shares can be clubbed together, part of their shares can be clubbed together, and it can be presented as one unit for mutual fund. Now, who is managing this? What kind of transparency that is there in this? Because as you can understand that there can be some manipulation in this formation of this particular unit. So to avoid such fraudulent things and maintain transparency in that, certain new recommendations are there to enhance accountability of broad asset management companies who is managing this entire portfolio, right? Recommendations given by SEBI is trustees should take the help of audits, legal firms and merchant banks for carrying out the diligence on their behalf. It can propose the constitution of a unit holder protection committee also by the board of AMC. A mutual fund is a pool of money managed by professional fund manager to be invested for making profit. That we have already understood. What is a mutual fund trustee? Mutual fund is in India have a three-tiered structure: mutual fund, the trustees and the AMC, right? That is asset management companies. That we have already seen. The board of the trustees holds the property of the mutual fund in trust for the benefit of the unit holders. They appoint asset management companies to float schemes for the mutual fund and manage the funds mobilized under various schemes. Now, various type of bonds. There are various bonds that we can understand: zero coupon bonds, zero coupon, zero principal, as we have seen in some cases when in social stock exchange, when you are investing or you are giving some donations, zero coupon, zero principal. So bond is a kind of financial instrument, right? You can use bond to invest money, right? You will be having bond, entire this repo rate, etc. We have seen the use of bond. Government also issues bond known as sometimes gilt edge bonds, or also known as treasury bills also, right, for a short term period. Markets regulator SEBI has strengthened the framework of for green debt securities by introducing the concept of blue and yellow bonds as new modes of sustainable finance. Now, green bonds basically related to climate resilient or for sustainable development. What are green bonds? Green debt securities. SEBI broadly defines green debt security as one of its that is issued for the purpose of raising capital to be used for cause of sustainable development or furthering energy efficiency. Under subcategories of green debt securities, blue bond is a debt instrument issued by government, development banks or other to raise capital for finance marine and ocean based projects that have positive environmental, economic and climate benefits. So blue refers to marine, right? Blue refers to marine. Framework to prevent fraud by stockbrokers. SEBI, the market regulator in India, has approved several proposals for boosting the corporate governance ecosystem and preventing fraud, market abuse by stockbrokers. So what kind of this step has been taken? So ending permanent directorship. SEBI has ended the practice of individuals holding permanent directorship on board of listed companies. So permanent directors will not be there. This move aims to boost corporate governance and encourage the appointment of independent directors who can provide an objective view. Now, framework to prevent fraud. If we talk about framework to prevent fraud, the SEBI has put in place a formal mechanism to prevent fraud and market abuse by stockbrokers. This step is expected to safeguard investors' money from misuse by stockbrokers. SEBI has approved a regulatory framework, right? Private equity funds for sponsor mutual funds, etc. So SEBI has approved the regulatory framework to allow private equity funds to become a sponsor of mutual funds. This move is expected to deepen the mutual fund industry in India. Right now, ESG disclosure. SEBI has given its nod to norm environment, social and governance. This is ESG, environmental, social and governance disclosure by listed company. What will be the impact? This step is expected to enhance transparency and encourage responsible corporate behavior. SEBI, this fund blocking facility. SEBI will introduce a fund blocking facility to secondary market transaction similar to one used for initial public offerings, right? When first time a firm is in listing itself. This measure is aimed at safeguarding investors' money from misuse by the stockbrokers. Additional tier 1 bonds and credit Swiss write down, etc. So this writing down is also a method by which the firms subscribe to the shares, right? If people are not buying it though, so the underwriters will buy it for sure. The recent purchase of Credit Suisse, a Swiss bank, by its rival, that is UBS, we have already seen, Universal Bank of Switzerland, has left investors struggling to understand the deal. One outcome that is causing significant distress is the decision to write down around SFRN, that is 16 billion, approximately 17 billion in that is Swiss franc. SFR is Swiss franc of 16 billion, that is around 17 billion dollar in additional tier 1 bonds issued by Credit Suisse, which could even spell at the end of asset class. So it is related to Switzerland, right? AT1 securities is a type of contingent convertible bonds developed after the global financial crisis of 2007 to 9, that is, it is referring to this subprime crisis of US in 2008, to prevent the need for government funded bailouts in struggling banks. So it is related to this. Now, not much is needed from this, the future of asset class, etc. Supreme Court names panel to review investor protection norms. Supreme Court announced an expert committee to examine India's investor protection regulatory framework following a crash in Adani Group securities, again related to Hindenburg only. We have already seen this, so we will not going into the details of it. 81 bonds, Swiss government broke. This is already we have seen. So why 80 bond, etc. This is not required. So we'll stop here for today. We will meet in the next class. So here insurance and investment part is over. We will meet in the next new video and with the new topics that is to be discussed. So stay tuned to Victory IAS YouTube channel so that you can have all the informations related to current affairs, right? So thank you very much. Take care. Bye bye.